Welcome, ladies and gentlemen. Greetings to this new webinar from Solarplaza. Today we're going to be talking about the regulatory and tax-related updates in the Polish renewable market. And already with us here, as you can see on your screens, is Katarzyna Klimkiewicz-Dyplano, who is a founding partner at Advisor Nexia, and Sławomir Patejuk, who is also partner at Advisor Nexia. And greetings, of course, from my end too. A quick intro from my end before jumping into today's webinar. We'll try to stay within the hour, especially if it's a beautiful sunny day here in Warsaw. Quick intro about Solarplaza. You may know us from the conference and events we organize all around the world. This year, third edition in Poland. I'm going to say maybe something more about it about the end. And as anticipation, of course, we can already mention that both Katarzyna and Sławomir representing Advisor will be there. Of course, that's not just it. Specifically, because we have two more branches. I'm gonna see if we can go to the next slide. I'm going to ask a bit of help. There we go. Solarplaza Consultancy, which run here especially, we support investors in terms of entering into new markets and acquiring new projects. Quite active also in Poland at the moment, so feel free to reach out eventually to me after the webinar to discuss more about how we can help on that front there. And also something which I'm proud of, Solarplaza Foundation, whereby we support some charitable projects related, of course, to PV all around the world, launched 3 years ago, still under the Solarplaza brand. Now let's jump into maybe some practical matters. Of course, just a reminder, we'll be seeing each other at Solarplaza Poland in Warsaw, May the 9th. Practical notes, yes. So first of all, feel free to send in your questions. There's also my colleague Bo behind the scenes. So we'll be having a Q&A time at the end, also for any technical issues. And since you always ask, yes, presentation for recordings will be available at the very end via email. Just give us 1 or 2 days and we'll send them. Agenda, very straightforward. So presentation, Q&A, and then we'll be ending the webinar. And I'm going to also have a quick introduction. So as you said, as I mentioned earlier, Katarzyna is the founding partner at Advisor Nexia and has been advising on tax-related issues, also at Anderson, EY, TP Howard, and now also here in Advisor, and has quite a broad experience in the advisory transaction field, due diligence, and tax planning. And also we've heard today is Sławomir Patejuk. Let's see if we can. Here we go. Who is also a partner in the tax and legal department and has been advising since 2007. On the matters we are also going to be discussing today. So from my end, that would be all. I'm going to leave the floor and stage to Katarzyna and Sławomir. As a reminder, send in your questions. We'll be addressing them at the end. There's the Q&A box for that. And enjoy the webinar. So Katarzyna and Sławomir, the floor is yours.
Thank you so much. So let me start with our presentation. Maybe I will add some words to the presentation, to the introduction that Nicola has just made. We, together with Sławomir, we've been advising the companies that are investing in renewables in Poland for years already, and we can see a huge development here, but also huge change when it comes to the tax environment, legal environment. We have good experience in it, not only with regard to the Polish market, due to the fact that our organization, our company is part of international network, Nexia International, We are in like a constant exchange of know-how, constant co-working, collaboration on joint projects with our colleagues from other companies that are part of Nexia. What do we do at Advicero Nexia? Next slide, please. We are doing tax advisory, but not only. We are also doing accounting outsourcing, payroll outsourcing among our clients. Most of them are actually those working in renewables field. We have very good experience in it. We work a lot when it comes to tax advisory in transactions. We do due diligence. We do advisory with regard to acquisitions, taking over of projects. We also advise a lot on the tax safety issues on the ongoing tax matters. What will we discuss today? So let's move to the next slide. Okay, still information about contacting us. We value a lot like updating our clients, our potential clients when it comes to tax, accounting, legal information related to the Polish market. If you want to follow what we publish, please join our profile on LinkedIn. We also have like talk about taxes profile on YouTube, where we publish short movies about the most up-to-date tax matters. So I think now we can move to our agenda for today. What we want to touch today, the subjects that we want to discuss today are the subjects that are mostly asked to us by our clients, by new investors who are coming to the Polish market, but also those who are on the Polish market. So usually we get the same main question: how to start investing in Poland? What is the best way to structure the investment? How to set up the entities? What type of legal entities shall it be? How to transfer projects between those entities, at what stage, how to provide financing, and so on and so on. We also work a lot on financial modeling from the tax perspective, and we advise our clients. We actually are consulted, are asking by our clients to provide consultants with regards to the tax items that are included in the financial models. And quite often we see there is either understatement or overstatement of some tax positions. We also want to touch upon this and to say which positions that you will find in the CAPEX or in OPEX will influence the future return on investment, and how should it be approached. So let's start with the structuring of the Polish investment. So is there one universal best structure, holding structure, financing structure for investing in Poland? No, there is not. It's always very much up to the setup that a given investor would like to have, or a given developer would like to have. It's also very much about the plans for the future. Is it more about developing and selling, or is it more about investing and keeping the investment and having and counting on the future distributions from it? It's also very much upon the structure of development. So is it going to be done by the investor himself, or is it going to be done in a cooperation with another entity, for example, with the local developer? What you see on this slide, it's like an example on how a structure could look like. So here, as you can see, the assumption is that there is a foreign investor who starts the cooperation with the local developer. The first question that usually arises in that case is how can they work together? So what shall be the legal form of their cooperation? Quite often it's a joint entity. It's an entity where both developer and investor participate, but it doesn't have to be an entity with those two shareholders. It can be also an agreement, cooperation agreement, where the rules for the cooperation are set. In case we have a joint entity where both those shareholders are participating, investor and developer, then the question is where this entity shall be set up. Shall it be a Polish entity, or is it better to have this entity abroad? And to find a solution to this question, to find the right answer, at least from the tax perspective. So obviously the business perspective is also very important here. But from the tax perspective, what needs to be analyzed, what needs to be thought of are several aspects. So first of all, withholding tax aspects. If we have the Polish holding entity, then obviously the payments, any payments that are made between this Polish holding entity and the foreign investor, they can be potentially subject to withholding tax in Poland. We will talk about withholding tax later on, but just in short words, the withholding tax might be due on several types of payments. So definitely on payment of interest, on payment of dividends, and also on payment for some intangible services. Also on payment for royalties, but those come not very often in case of renewable investment. So in case the company that is called on this structure here, in case the JV Holdco is a Polish entity and JV Holdco is going to make any payment to the investor, for example, related to dividends, related to interest, one has to consider that those payments might be reduced by the withholding tax that is due in Poland. Then another aspect that should be considered when deciding if the JV Holdco shall be there and if it shall be a Polish entity is related to how the development of projects will look like. Will the projects, the new projects, be started and developed at least at the beginning in the JV Holdco, or shall they be developed from the very early stage already in the dedicated project entity, the ones that are called on this picture SPV. So if you have the project developed from the very beginning in SPV, the risk that is taken there is that in case the project fails, the costs related to the failure of this project, so the cost of the costs incurred so far will be in SPV, and either this SPV will be used to work on another subsequent project, or it will be subject to liquidation. And in that case, those discontinued investment costs related to it will be somehow lost, will not be deducted from any future profit. So from this perspective, quite a good solution is to start new projects in one company. This could be this JV Holdco company. In case it's going to be like this, that the new projects are started in one company, JV Holdco company, then obviously it's better that this JV Holdco company is a Polish entity and not a foreign one. And then the decision about transferring this project will be like a next step, and those projects could be transferred to dedicated SPV only at the stage when there is like a certain probability of success for them. Another aspect to consider when deciding if JV Holdco shall be in Poland or shall be abroad is the planned future exit from the investment. The planned exit is usually the share deal. So it's usually planned sooner or later, depending on the preferences, that SPVs with project will be sold via share deal. And then the possibility shall be studied if such sale can be done without any taxation. There are countries, like for example, in Germany, there is this holding companies regime where basically sale of shares in a subsidiary under meetings, when certain conditions are met, can be done almost with zero taxation. For some time already, we have also similar regime in Poland. It's there just for right now, like slightly over 1 year. It's a quite new regulation, and it says that if, in this case, this JV holdco can meet the conditions for being qualified as so-called holding company, then sale of shares of the underlying entities, in this case those SPVs 1, 2, 3, can be subject to income tax exemption. Obviously, there are additional conditions to be met, like the holding period of at least 2 years, like the minimal holding of shares of at least 10%. And also another important condition is this exemption on the sale of shares. It applies only if the sale is done to unrelated company. So if those conditions can be made, then the Polish JV holdco, if it's a Polish entity, can potentially benefit from income tax exemption. So all those aspects, they need to be considered when deciding how to structure the holding and if all those underlying entities shall be in Poland or not. Other questions that we quite often get are when and how to transfer the projects that have been started, what is the good time point, and what shall be actually, how the fee for transferring such project shall be determined. So how actually the value of the project at the moment of transfer shall be determined. So again, there is no one good answer to such question. What needs to be considered here, what is very important is that first of all, any remuneration for the transfer of project that is agreed has to be at arm's length. What does it mean? It has to be in line with market conditions. So it has to be the market price, even if both JV holdco and the SPV are related entity, and actually none of them, from the business point of view, would question a lower price if a lower price than market conditions is set. Here the regulations are quite clear. For any such transaction done between related parties, it has to be arm's length. Usually it means that the price has to be higher than the investor would like to have it. Such transfer of project will be subject to income tax. It will be very difficult to avoid income taxation. If it's done via sale, those proceeds from sale will be subject to tax. They can be decreased by costs related to creation of this project, development of this project, but those costs are usually significantly lower than the proceeds from sale. The same we will have income taxation if it's chosen to make so-called contribution in kind. So to dispose the project from JV holdco to SPV by contributing it on the capital of SPV. We will have income taxation here as well, actually at the same level as it would be in case of like a simple sale. Another issue to be considered here is what will be the revenue source for JV holdco from such disposal of project. Later on, I will tell you what is the difference between the revenue sources and the corporate income tax rate related to both. However, one need to consider that if the project rights that are transferred from JV holdco to SPV could be classified as intellectual property, so as property rights in the meaning of the property rights law, then they would be classified to another source, to the other source related to capital gains that is subject to standard rate 19%. But what we gain in that case, we have the chances to potentially decrease the real estate taxation in the future when the project is already finalized. We will talk about it later as well. In case there can be no intellectual property rights related to the project rights that are transferred, then we would have classification into so-called other revenue source, where we could potentially apply 19% tax or 9% tax. I have outlined shortly the possibility to exclude from taxation the sale of shares done by so-called holding company. So to apply exemption on such sale, we have another potential exemption for the sale of shares. And this is applicable in case the JV holdco could be classified as so-called alternative investment entity. So alternative investment entity is an entity that is governed by the law on the investment funds. It's one of the alternative investment funds. There are obviously some conditions that need to be met by such entity to be classified as so-called ASI, so alternative investment entity. The benefit of such classification is, as I mentioned, the exemption for disposal of shares of subsidiaries. Here again, condition at least 5% holding for at least 2-year period. There are obviously also downsides. So ASI needs to meet specific conditions, needs to have the managing entity is underlying this law about investment funds. So it's also underlying the supervision of KNF, of the Polish supervisory institution over the financial market. Another condition that is quite crucial here, that the only aim of the business activity of JV Holdco is to gather funds from investor and to invest them in line with the assumed investment policy. This means that basically, in order to meet this condition, JV Holdco could not make the development of projects. Still, I think it's quite interesting solution, and despite all those conditions that need to be made, maybe in some situation could prove profitable for the investor. So definitely, it's worth investigating and verifying. Last 2 points that are important in case of choosing the best investment holding financing structure is how the future profit distribution is going to be made, when it's going to be made, what are the amounts, what is the type of the company that is the ultimate beneficiary, so investor or maybe the ultimate parent of the investor. In what jurisdictions are they based, how the financing is going to be made. All of this has an impact on the final shape of the holding structure, so all of this should be considered. So let's now move to the aspects relating to financing of a project in Poland. Let's move to the next slide. This is also a question that we get quite often from our clients, how to provide financing to Poland. Basically, there are 3 main options. So one is debt equity, so loans, either from the shareholders, from a related company, or from unrelated financial institution, for example, bank. The second option is increase of equity in a Polish entity, and here either increase of share capital only, or increase that is split between share and supplementary capital. And the third option is financing from shareholder, but in form of so-called additional payments. This institution of additional payments that are treated as reserve capital is present not only in the Polish law for commercial companies, but also in other jurisdictions. Basically, in case like the difference between additional payments of shareholder and simple share capital increase is that it's much more easy to refund to the shareholders the additional payments. They are forming a part of reserve capital, not of the part of the share capital, but still both are part of the equity, which can be important in case of the further subsequent bank financing. Basically those additional payments, they can be interest or not, while share capital can never be interest. However, in case we have the interest agreed on additional payments, it's important to mention that such interest on additional payments will never be tax deductible costs for the Polish entity that got those additional payments. It will be, on the other hand, the revenue for the shareholders. Let's move to the next slide, where you can see some tax details related to those three main types of financing. So the first, when we compare which type of financing is the most convenient one for the investor, for the Polish subsidiary, the first important aspect to consider is the so-called tax on civil law transactions. So tax on civil law transactions is due, as the name shows, on some types of civil law transactions, including the increase of share capital, including granting of loans. There is no tax on civil law transactions in case the financing is granted by the financial institution. So in case there is a loan from the bank, there will be no TCLT. In case there is like a regular loan from any entity, it's subject to 0.5% of TCLT. The taxable basis is the amount of loan granted. And here we have some exemptions available. The first main exemption is for the shareholder loans. So whenever the loan is granted by a shareholder, doesn't matter what is the shareholding level, it will be always exempted. The exemption is not available in case this is granted by the mother company, by the sister company, or any other related company. However, here can we use the general exemption for financial services. So because financial services generally are taxed under VAT law, they are exempted from VAT. This means that they are not subject to the law on tax on civil law transactions. And in case we classify the financing as financial service, we can also have the exemption here. For the share increase, share capital increase, we have again 0.5% tax, and there is no exemption available. But we don't have an TCLT on the supplementary capital increase. And this is the reason why sometimes the investors, they choose to increase capital and to divide this increase between share capital and supplementary capital. Because like this, they can optimize the burden of the TCLT. In case we have this institution of additional payments, then we have 0.5% TCLT, we cannot avoid it. In case of financing, we also need to consider withholding tax. Generally on interest payments, there is 20% of withholding tax. And obviously, whenever we will have the payment or capitalization, so adding to the loan principal of interest, they will be withholding tax due with some exemptions available. Exemptions for the loans that are granted by parent entity or sister entity. Here, 25% of holding is required. Some reductions in withholding for loans granted by companies from other jurisdictions where the double taxation treaty provides for the possibility to reduce the tax. In case we have the financing through increase of capital, then obviously we will not have the interest payment, but we will have in the future dividend payment. So there we will have generally 19% on the payment of dividend, but again, we have the possibility to apply exemption or reduce this withholding in case the exemption cannot be applied. Interest paid is generally tax deductible cost for the paying entity, with, however, application of thin capitalization restriction. I will talk about it in a moment. And also what needs to be remembered is that whenever there is increase in the capital of the subsidiary of the SPV, Then in case of the future sale of the shares of this SPV, this increased capital that is constituting part of the acquisition cost of the shares will decrease the taxable basis for the seller, unless the exemption on the sale of shares can be applied. Let's move to the next slide, and let's focus on the possibilities to deduct the interest cost. So as I have mentioned before, we have the basic rate for corporate income tax, which is 19%, and it's applicable on any revenue that is gained from so-called other sources of revenues. And on these revenues from other sources, we can also potentially have 9% of income tax rate, which is applicable to so-called small entities. So entities who start their activity, entities who are already in a subsequent year of running business activity. However, they have the annual revenues below 2 million euro, Polish zloty equivalent. We cannot apply this 9% on the revenue from the source capital income. So in case we have capital gains, there we will have generally 19%, irrespective of the level of turnover of an entity. When it comes to deductibility of interest cost, they are deductible when capitalized into the loan principal or when they are paid. If they are accrued, so disclosed only for accounting purposes, they generally do not constitute tax deductible cost. If those interest costs are incurred during the investment phase, then generally they cannot be directly shown in a profit and loss account. They have to be added to the initial value of the project. And this also impacts later on the overall depreciation basis of the project, which also impacts the overall taxable basis for the real estate tax. So sometimes when we have like a big time span between like giving the investment, so having the investment process finalized and the investment is already officially given for use, but we are still waiting for the generation license. Generally, in line with the legal regulations, we shall accrue all expenses. So in this phase between giving the asset for use and getting the generation license, we will have generally only the interest cost, only the financial cost, but in line with the law, we have to accrue them into the initial value of the investment. Usually investors don't like it because this is like pumping up the overall value of the investment, which is then leading to the increased cost of the real estate tax. I'm sure Sławomir will mention it later. What about the fin capitalization restrictions? Let's move to the next slide. So in Poland, we have the rules that are binding in other European Union entities, resulting from the so-called ATA directive. These fin capitalization restrictions, they apply to financial costs paid to both related and unrelated parties. There is a safe harbor amount, which is 3 million Polish zloty per year. Whenever the financial costs are higher than that amount, then we have to check what is the level of the 30% of so-called tax EBITDA. So difference between the revenues with some exceptions and the cost with some exceptions. If this 30% of EBITDA is higher than 3 million Polish zloty, then we can include 30% EBITDA. We can include interest costs up to 30% of tax EBITDA into tax deductible costs. If it's lower, then we have the right to include 3 million Polish zloty as interest costs. If our interest costs are higher than those amounts, but EBITDA doesn't allow us to include all of them into tax deductible cost of a given year, then we have the possibility to include them into tax costs within any of the 5 subsequent years, but we need to verify this mentioned limit in every of these 5 years. There is one exception from this fin cap limitation. It applies to so-called public infrastructure investments. Surprisingly, also like a private renewable investments are usually classified by Polish administrative courts as public infrastructure investments. And in case in a given investment, there are the financial costs that are much higher than 3 million Polish zloty, much higher than 30% EBITDA, it's really worth to get the confirmation that actually our investment can be classified as public infrastructure investment, and that we have the right to include all related costs into tax deductible costs. Let's move to the next slide. Last point from my side that I would like to make. Transfer pricing regulations, also very important in case of renewable investment, because on one hand, we need to make sure that whenever we have the interest on the financing agreed, it has to be at arm's length. And there are some guidelines from the Polish Ministry of Finance on what is actually the market level of the interest, but obviously it needs to be verified case by case. On the other hand, when we talk about transferring the projects between the company in which they are developed, so either the developing entity or the joint venture entity, we also need to make this transfer to the SPV based on the market prices. We need also to make it probable that the price that we have assumed is the market price. What does it mean to make it probable? To create the defect file, to gather the comparable data. In some cases where the value of the transaction increases, the thresholds. We also need to prepare the local transfer pricing documentation, and from there it must result that actually what we have is in line with the market prices. So let's move to the next topic, and I leave the floor for Sławomir.
Hello, good morning to everybody once again. In the last part of this presentation, I would like to mention some additional tax topics which are crucial for investors in Poland. And the first one is real estate tax, and the question how is it calculated. This local Polish tax is very specific. In other countries, generally, it's not applicable. In Poland, in case of many investments, it could be a huge burden. As well, this concerns also PV projects, and the construction of this specific tax says that the tax is levied by the local municipalities. So each municipality in Poland, it's almost 5,000 of them, could have a little bit different rules, and the rules are somehow unified. Some approach is related to the local municipality. Also, the tax rates could be slightly different in different locations. When we look at the PV project, the first question is whether the real estate tax is due or the agricultural tax is due. The level and the tax rates are different in case of these both taxes. And of course, real estate tax is generally much higher than the agricultural tax. Unfortunately, generally, Polish tax authorities present the standpoint that in case of PV investments, it's business, and the business use is prevailing, so the real estate tax is due. Anyway, there is some part of investors which try to tax the investment with agricultural tax, or at least a part of the investment, and try to save money. It should be analyzed case by case. As I said, it depends a little bit on the approach of the local tax authorities. However, assuming this, let's say, standard setup and safe approach, and assuming that we would pay real estate tax, then some additional questions arise. What is the subject of this real estate tax and not? Generally, in case of such investments, we have to analyze which part of the investments are so-called structures, and then the tax basis for real estate tax is the gross tax value of these parts of these structures. and standard tax rate is 2%. So if each investor has to pay 2% of the part of its investments each year to the local tax authorities, it results that this burden could be pretty high. And so when we look at the particular parts of the PV investment, then there are parts which are for sure are not subject to real estate tax. They are presented on the next slide. For instance, photovoltaic panels, there's no question that panels are not the subject of this tax. However, on the opposite side, the cables, the substation, the transformers are subject, and there's few parts which is not clear how to approach them. In case of pillars and the foundations, it could be a question which part should be taxed, and the same applies to the mounting system. All these steels, these rows, clamps. A different approach of different investors could be applied. And what is important when we look at this real estate tax, on the one hand, investigate what is the approach of this particular local tax authorities that where you would like to invest. And the second advice is at the moment of booking of costs or of BOP of another contracts, it could be analyzed which parts of the contracts could be booked to the which fixed assets, because the step 0 is, as I said, is preparation of fixed asset register. So all investment costs should be allocated to the particular fixed assets, and then basing on this, the real estate tax should be calculated. There is some potential optimizations. For instance, project rights. In some cases, project rights could be treated as separate intangible assets, which could be not subject to real estate tax. So it always depends on the factual state and on the particular situation of each SPV. Let's meet to the next slides, and I would like to tell you a little bit about few another aspects. Few of them was already discussed. When we look at the crucial tax burdens in Poland, of course, it is corporate income tax and VAT, value-added tax. In case of corporate income tax, the rate is either 19 or 9%. 9% is available for small entities, small taxpayers with turnover below 2 million euros, and so the rates are not so high. In case of VAT, generally it's tax neutral tax. However, if you don't follow some restrictions related to this tax, it could be potentially result in risk of VAT deductibility of the tax resulted from your purchase invoices, or in the worst case scenario, Polish tax authorities could impose VAT sanction amounting to approximately 30% of the value of the invoices. So some rules should be in this regard should be observed. Tax on civil law transactions, it's up to 2%. It's some particular transactions are, for instance, related to the financing or acquisition of some some rights or real estates, and withholding tax. So let's jump to this next topic. Withholding tax in Poland is one of the most important aspects which should be considered by investors. The tax rate, the standard tax rate, amounts to 20%. In case of dividends, it's 19%. And what is the subject of this tax? This is interest, royalties, dividends, and huge scope of intangible services. So any remuneration for advisory, accounting, legal, data processing, employment, and so on and so on is subject to this tax. So in case that the Polish entity pays such kind of remunerations to foreign entity, to foreign persons, as a rule, the withholding tax at the rate 20% or 19% should be collected, withheld by the Polish SPV and paid by the Polish tax authorities. However, on the next slide, they are presented some exemptions or reductions of this tax based on the double tax treaties concluded by Poland, as well as European Union directives. It is possible either to exempt or to reduce this level of the taxation. It depends on the particular situation. However, what is important that there are formal requirements allowing to this. So the Polish entity has to fulfill some formal obligations. So certificate of residence should be possessed by the Polish entity before the execution of such payment. Some additional statements, written statements, should be possessed. And what is very unfair a little bit, and it's a pretty new regulation, it's the beneficial owner test. So the Polish SPV has to prove or has to investigate who is the beneficial owner of this particular remuneration, and the risk should be excluded whether the remuneration is paid to the holding company without any or with small business substance in the country of the residence. So any payments to holding companies or any payment to the entities which the status for us is unknown are at risk. So it should be considered at the moment of the planning of the investment. And also, so the second aspect which should be considered, this is pay and refund procedure, which was introduced last year in Poland. This regulations, this limitation concerns payments of interest, dividends, and royalties to related entities, and is applicable in case that the annual amount of such remuneration exceeds 2 million Polish zloty. So in case that Polish SPV, Polish company, would pay, for instance, interest in the given year, and the interest amount is higher than 2 million Polish zloty, then the Polish SPV is obliged, as a rule, to collect Polish withholding tax at the rate 20%, and after that, the foreign entity could apply for refund of such withholding tax. So it should be known for all parties from the beginning that such risk exists in case of particular payment. There are two exemptions allowing you not to deduct, not to pay this the 20% withholding tax from the beginning. The first one is application is a submission of special statement to the Polish tax authorities, which should be submitted by the members of management board, which declare that all formal conditions are fulfilled. So all these certificates, all these statements are possessed by the Polish SPV, and the members of management board confirm that the entity receiving this remuneration is the beneficial owner. Then it's possible not to collect withheld this withholding tax. Or the second possibility, it is possible to apply for special, let's say, withholding tax tax ruling. It's called opinion of the application of preferences, which is valid for 3 years. So Polish SPV could apply for such opinion, for such tax ruling, allowing this entity not to pay the withholding tax. So please consider, because it's one of the most important tax aspects that you have to be aware in case of investment in Poland, this withholding tax. The next topic which I would like to mention, it relates to the VAT, and it's presented on the next slide. In Poland, we've got local requirements related to whitelist and split payment, which we see it's problematic for investors. And what's going on? It's the situation when the Polish entity pays for invoice, and this invoice includes Polish VAT. In such case, in the first step, the Polish SPVs, also the buyer, has to check what the bank account provided by the seller is, and it should be checked whether this bank account is presented on the so-called whitelist. Whitelist is an official breakdown database of the Polish Ministry of Finance, when you can see all Polish VAT taxpayers and their bank account numbers. So it's official. You can check it. And if in case that such bank account is not listed there, then the Polish SPV has to submit some special notification about such payment at not later than 2 weeks after execution of such payment. If you would not to follow this rule, then as a rule, there is not possibility to trade the net amount resulted from such invoice as tax deductible costs. So imagine that you pay for PV panels or for assembly, for BOP, and so huge amounts related to your investment, and then because of this whitelist regulation, it's not possible to trade it for the future as tax deductible, either for the ongoing basis or as a depreciation basis. The second issue, it's split payment mechanism, is also very local Polish requirement, and in case of some specific goods or services, you have to follow this regulation. And in short speaking, VAT amount resulted from the invoice has to be paid to the special VAT bank account of the seller. It's possible to do it, such kind of transfer, only between two Polish bank accounts. So you have to be aware, and you have to analyze whether the invoice which you receive are subject to this regulation or not. On the last slide, we present some do's and don'ts for an investor, so some summary. So what should we do? Please plan the holding and financial structure in advance in order to avoid in future any changing of this. Please prepare a realistic financial model, including all future costs, making realistic assumptions, because sometimes we see business plans which looks very nice from the beginning, but then we saw that there are some too optimistic assumptions, for instance related to real estate tax. Then the next topic is of course this real estate tax. So please check it, how it's calculated, what kind of costs you expect, and it should be considered. Regarding withholding tax, please check how you would like to execute the payments, especially related to the financing or dividends, and whether you would have any problem with this beneficial owner test or not. Sometimes it's better to restructure a little bit the holding structure, and for instance pay to another entity the interest and benefit from the, let's say, withholding tax rate 5% instead of exemption, but exemptions could be questioned because there is no substance of the holding company. The last point, what to do, it's please observe these local requirements related to the split payment and whitelist. And what not to do, please don't buy the unverified projects. Due diligence, legal, tax, and of course potentially also technical is must. In case of tax, the state or the time of limitation is more than 5 years, 5 or 6 years, dependent on the tax. So the risk, if you buy the SPV, the risk remains with you. Don't pay any tax liabilities for another entity. Generally, it's not possible to in Poland that different company pays taxes for another entity. And the last question, what not to do, don't make any transfers between entities without a legal title. This concerns also the situation when, let's say, the Polish SPV received invoices for BOP, and the invoices are paid by mother company in any another country. So it's possible, but you have to have documents and legal titles to execute such payments. Okay, it was the last slide, and the last topic that we would like to present. I don't know whether there are any questions to the presentation.
Thank you, Katarzyna and Sławomir. Yes, indeed, there are a couple of questions maybe we can address now, although looking also at the presentation, part of them were covered, but let us still maybe quickly touch on them. The first one was on the withholding tax. Before we mentioned also a possible exemption on the withholding tax. Could you maybe clarify, just in a nutshell, when this exemption is available?
Okay, so it depends a little bit what kind of remuneration we are talking about. In case of intangible services, this is the simplest exemptions, because generally it's possible to exempt such remuneration based on the double tax treaty. And for instance, payment for marketing services or advisory services, as a rule, could be withholding tax exempt. In case of interest or dividends, they are available exemptions resulted from the double tax treaties, mainly to 5 or to 10%, so reduction of withholding tax. In case of payments to mother companies in European Union for interest or royalties or dividends, as a rule, the withholding tax exemptions could be applied. But this applies to the entities in European Union.
Very clear, Franco. One question also related to land tax, which we have maybe not.
Land tax, it's different name of real estate tax. It is
different, yeah. Exactly. So that is also a clarification, because that is also maybe something which you want to maybe expand, is that it is sometimes mistaken perhaps that real estate tax is not intended as land tax, but that is also an important clarification to make. And maybe allows maybe for last question, before we also discussed the principle of the arm's length transaction, and maybe allow me here a comment. The question that came is a bit unclear. We were discussing about which market reference prices are used to determine the transaction here. Could you perhaps expand a little bit on that to explain which market reference prices are used, and maybe for the sake of clarity, related to utility scale projects, given that we are focusing mostly on these ones?
Yeah, so basically here, the regulations are also quite precise and quite clear when it comes to the rules, obviously, not when it comes to the specific levels of the market prices. So when it comes to the rules, we can have either the internal comparison or the external comparison. Internal comparison, if we sell projects to related parties, so we move the projects at certain stage to our subsidiary, and we also move similar projects to unrelated companies, then we have the quite simple comparison, because the market level of the price that we should apply for our internal transaction should be comparable to the one that we have applied when selling to unrelated company. The external comparison means that we don't have sales of similar projects, our projects, to unrelated companies, but we can see what is happening on the market. So we can see for which price similar projects at similar stage have been sold between other companies and related companies, and we apply similar price to our sale. I don't say the same price, I'm talking about similar price. And why? Because every project is different, every sale transaction is different, every location actually is different, and different risks are related to a given project. So we always have the possibility to play a bit with the market levels, because we can always say our project, so probability of success for our project is actually lower than in case of comparable projects that we had on the market. That's why we put our price a bit lower. Or maybe the other way around, the probability for our project is higher, that's why our price should be higher. So when I was talking about defense fight, what does it mean? It means that whatever price we take, we need to be able to defend it in the future in front of the tax authorities, because here is what we are talking about a potential tax audit started by tax authority for us or for the subsidiary, and we need to defend the price that we have assumed. So if tax authority says the price is too low, you should have applied higher price, so the revenues for the seller are understated, we need to be able to make sure that we can prove that the price we have applied was actually the market price. So I will not refer to specific numbers now, because every project is different. Every stage, like every transaction is done at a different stage. But we need to keep in mind that the price we assume should be the price that we would have requested from our unrelated party if we were selling to unrelated party.
Clear. Thank you, Katarzyna. And I think that with this one we can wrap up the Q&A and the presentation, which we thank you very much. That said, of course, Advisor will also be at Solarplaza Summit Pool, and just a reminder on May the 9th, also as partner. For those of us that follow us, also a kind of reminder, if you would like to register, we have for the conference, there is also a discount available, so make sure to use of that. And that said, once again, Katarzyna, thank you very much for the insights. I know we'll be covering also perhaps more in depth and also with Triangle in 1 month also at Solarplaza, Poland.
Thank you very
so
much.
Thank you, and thanks to all of us for attendees that have been following. Thank you very much.
Thanks. Have a nice day to everybody.